Good morning, everyone. Welcome to another episode of the Mizuho Week Ahead. I am Boon Heng, Market Economist at Mizuho Bank. This week's theme is Relief and Restrictions. Relief for markets last week came in the form of a 90-day trade truce between the US and China, with the US lowering tariffs on Chinese imports to 30% and China lowering tariffs on US goods to 10% to facilitate negotiations going forward. While the reduction appears to be massive from the initial prohibitive levels, one ought to ponder about the effective level of tariffs, which implies a de facto trade embargo. This will imply a more realistic level of relief afforded to businesses facing increasing costs. On that note, US PPI undershooting expectations, alongside softer retail sales in the US, saw US CEUs soften towards the end of last week as retailers pondered about their ability to raise prices, with households growing increasingly sensitive to price changes. While households worry about the potential price increases, some may begin to hope for US fiscal tax cuts for some relief, which range from removing taxes on tips and, over time, as well as the ability to deduct interest on car loans from their taxable income. That said, other details such as powering back food stamp programs and health insurance funding also imply that household budgets may feel a little more stretched for the next year. Nonetheless, the overall fiscal implications of higher deficits will not be lost on long-end USD yields. Over the weekend, Moody's downgrade of US credit rating, which comes as a one-notch downgrade of US credit ratings from AAA to AA1 by Moody's, is admittedly significant as the US loses its last top-notch ratings. The resultant jolt may restrict already tentative market optimism, but the downgrade does not adversely impact the liquidity and collateral value of USDs, therefore not presenting an inadvertent and imminent shock from forced liquidation. Above all, there are no AAA alternatives for markets that are sufficiently deep and liquid to threaten the reserve asset status of USDs that is tagged to the US dollar's global reserve currency status. So this will neither be a crisis for USDs and US dollars reserve currency status, nor an inadvertent shock to global liquidity plumbing. Across the Atlantic, the EU is reportedly revising proposals for a trade deal with details to lower both tariff and non-tariff barriers, alongside investments in LNG and purchases of semiconductors. Conceding on energy and critical tech purchases are perhaps the closest to a win-win outcome. Over in India, a ceasefire with Pakistan is welcome news, but was insufficient relief to revive the fortunes of the rupee, which underperformed last week. The underperformance comes as Trump stated that India was willing to remove all tariffs, which was later cautioned by Indian authorities as being premature. Furthermore, Trump picking an issue with Apple producing phones in India also dampens India's allure as replacing China as a manufacturing hub. In Japan, Q1 GDP disappointed as consumption growth was flat, but exports demand fell. Down under, Australia's job gains were robust, with a total of 89k job gains, of which 2/3 are of a full-time nature. Looking ahead, the RBA at their meeting on the 20th of May is likely to persist with calibrated easing that will be framed as lowering restrictiveness of monetary policy amid a backdrop of tariff-led disruptions, of which a 10% baseline looks increasingly permanent. In Indonesia, easing though is too bitter a pill to swallow for Bank Indonesia at this juncture, as the rupiah underperformed regional peers even amid the soft dollar backdrop. In short, the rupiah will restrict Bank Indonesia's policy option this week to a rate hold. We expect Thailand Q1 GDP on Monday to produce a still decent print of around 2.7% amid some buoyancy off the back of front-loading of exports, which saw substantial goods balance surplus. Nonetheless, the drawdown of inventory and slower consumption spending is expected to drag on growth. All in, while EM Asia FX has been afforded tailwinds of relief from dollar pressures, the still-in-place tariff restrictions may begin to make its grip on regional economies, and risk assets may differentiate along the lines of varying US fiscal and tariff relief. For more information, please refer to our research publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.